Greetings and welcome to the April 2025 Investment Strategy Brief. In this episode, basically I want to get into the idea of keeping a lookout or watching for the uncertainty that we've been experiencing to fade a little bit, for things to become just a little bit more clear. So let's jump into it. To take a step back, recall that we did discuss in past episodes our base case scenario and our bear case scenario from our outlook. And just to review, essentially what we're really focused on are the top three sort of paths that we've identified here on this slide. An erosion of animal spirits really related to erratic policy and poor communication from the administration. The idea of that, especially the trade war, tipping us into a global recession, that potential. And if that happens, coupled with still elevated inflation, we're in a period of potentially sustained stagflation. So those are the negative paths that we're keeping an eye open for. And I would say the market at some level has been pricing in. Now is not uncommon. We're actually a little bit more positive than the consensus view out there, in my opinion. But just to take a step back, basically, when it comes to this DC transition, we know that, of course, there's a lot of tariff activity, trade policy activity. We know that there's going to be a focus on tax. We know that there's a focus on efficiency through DOGE, big changes in health and human services, big changes that have been affected with immigration, and big change in the Department of Education. So really meaningful change in DC. The market seemed to be quite focused on tariffs and trade policy and the potential for recession that comes with that. Now, we're very fortunate to have Brian Gardner. That's Stifel's chief Washington policy strategist. I've spent a lot of time with him in the last number of weeks on these topics. And, I think Brian was very insightful when he sort of talked about when the tariffs were first announced, the idea that they could stay in place, there could be negotiation, or there could be a pause. And a lot of folks sort of questioned that last possibility, but that's, of course, what ended up happening, as we saw a 90-day pause implemented, and the markets have recovered a little bit as a result. And in some ways, I think that sort of captures where we think things are headed, in the idea being that it's going to be a little bit opaque, it's going to be hard to track, but at the end of the day, we anticipate the administration going sort of from country to country and trying to negotiate a good trade deal with each country, including ultimately China, trying to get to work to essentially negotiate a trade deal with China. So we'll see how that all unfolds. But again, I think there's a lot of focus on the economy. We come after a period of really strong growth in 2023, 2024, and essentially an initial set of forecasts that we're calling for continued growth in 2025. But of course, especially these trade issues have arisen, the tariffs were put in place, a lot of folks have been, including our own Dr. Lindsay Pieggs at Stifel, basically people are reducing their forecast for 2025. But it's just a handful of firms that are calling for a technical recession, meaning 2 quarters in a row of negative growth. But you can see people are sort of down in the range of sort of 1 to 1.7, 1.8 in terms of where people are, in the consensus falling to about 1.7% for GDP growth in 2025. Now, recall we had suggested the growth would fall between 1.5% and 2.5% this year, and so we're sort of at the lower end of that range at this point. Now, as it relates to Dr. Pieggs, essentially, I'd say a couple interesting things from the great work that she does. The first is indeed that she's lowered her forecast in recognition of the frictions of the tariffs and trade policy. But another thing that she's done is to raise her forecast for inflation. And she's very good at sort of discerning what the Fed is up to, and has, in some ways, strong views on what the Fed should do. And to sort of summarize that, I think she anticipates, like many, that the Fed will end up cutting rates this year, but she's actually in the camp, given that increased potential for higher inflation, basically, that the Fed shouldn't cut. And I've heard her in at least informal conversation talk about the potential for even suggesting that the Fed should hike rates at this point. Again, just very fortunate to have these very capable colleagues working here at Stifel. As it relates to inflation, in any event, for all the worry about a look forward, the last couple of prints, if you will, for the consumer price index and the producer price index were very low, so that was a good sign. But again, everyone's expecting inflation to heat back up. And in fact, what's interesting is when we look at the Fed funds futures, when you think inflation is going to be high, you would think that the Fed won't cut rates. But of course, the other side of the coin here, which we'll get to in a second, is the economy, and basically worries about uncertainty and a slowdown from the tariffs and trade policy. So we've seen priced in sometimes for, in this case, 3/4 point cuts in 2025 from the Fed, really in response to the potential for a slowing economy and therefore sort of pressure on the job market. And in fact, that sort of brings into focus the Fed's dual mandate. They're kind of caught in between these two objectives of their dual mandate, maximum employment and stable prices, in that if we see a lot of weakening in the economy and that affects jobs, then we get out of balance when it comes to employment. But if we see inflation heat up because of tariffs, then we're out of balance as it relates to prices. And so they're in a tricky spot right now of having to navigate between these two pressures, if you will. And I guess, again, the biggest worry is that we have recession and inflation, or what's called stagflation. So that balance from the Fed is something that's in keen focus. Now, we have talked before about the idea that fiscal transition really needs to occur in the U.S. as it relates to the level of debt that our economy has built up since the financial crisis, but especially our federal government. And again, we've gone over these numbers before, but as it stands, the market continues to price in elevated interest rates going forward. So the cost of debt is going to continue to stay high and get higher as bonds mature and new bonds are issued. And you can see still that our current 2024 numbers show that 33% of our discretionary budget went towards just servicing the debt. So we have officials, as we've talked before, both from the government and from corporate America, the leaders in corporate America, talking about the need to strengthen our situation in terms of the fiscal status of the government. That means lower deficits, less spending, more efficient spending, presumably. And then we're going to have to figure out that idea of whether it's low taxes and a stronger economy or the need for higher taxes for direct revenue. So again, this will be in focus as we move forward. Now, turning to the markets, as I mentioned, interest rates remain elevated. And what's been interesting about watching the potential for Fed cuts, it's often the case when the market's anticipating Fed cuts that the market interest rates actually anticipate that and they fall. And that really hasn't happened much in the current environment. And so it begs the question, well, why do the rates remain elevated? And it does relate a little bit to basically the time premium. What do investors look for in terms of wanting a return on their investment to invest in this case, U.S. government bonds? And it brings into question, it's almost like the creditworthiness of the government. If we see continued buildup of debt, then people start to worry about the idea of default. And just incrementally, that brings yields a little bit higher, which for the investors, maybe not bad, right? They're going to get a higher yield, but it is sort of the foundation of our interest rate structure in our economy. And so to have rates higher, obviously, again, increases the cost of debt. And so we're watching to see if and when interest rates start to fall. Now, as it relates to the equity market, we looked at this chart before. It captures President Trump's first term. This is the first year of the equity market, or in the first year of his first term. And then the blue happens to be the average of all presidential terms, the first year. The gray line is this year, and you can see the big decline. And then the market's tried to recover. It's come back down. It's tried to recover again. And so, you can almost think of it as the tariffs being announced, market falls. The pause gets announced, the market rises. Then there's things bouncing around, and this latest rise relates to sort of signals from the administration that they're in pretty aggressive and active negotiations with a number of countries. So again, we'll see how things go from here. But one thing that we like to remind ourselves is when we look at kind of the level of markets, and this was just created just a little earlier today, to kind of capture where the S&P 500 happened to be. And essentially, we're at a level, as of that moment at least, where if we look back in time to the date that level was the market's record, it was June 18th, 2024. So sometimes when I'm talking to people about how they feel about this current environment, people get very nervous or upset about the decline. But then I ask the question, well, how were you feeling back in the middle of 2024 in terms of the level of your portfolios? And people would say, I felt pretty good. So we're kind of back to that level. So it's hard to give up some of the growth that's occurred since then, but we're not in, if you will, sort of dire situations at this point in terms of the markets. Now, as it relates to valuation, which we've looked at before, and this happened to be struck the night before this day I'm recording, and basically what we see is the market sits still on a cap-weighted basis at a little bit of a premium to PE ratio averages over the last 10 years, but at a discount when it comes to the equal-weighted look, which we've talked about before, the idea of the potential for a broadening market. And turning therefore to the returns, this kind of captures, I think an important column to look at is essentially the year-to-date figures. And you can see S&P 500 down just under 8%. And so, that's an interesting level in the sense that when we look at our capital market assumptions, for example, essentially we expect that to happen, a level of return like that or worse, about once every 6 years. So it's not that uncommon, that infrequent, if you will. But we can also see patterns like value stocks doing a little better, growth stocks doing a little bit worse, and the Mag 7 sort of leading things lower after having led things higher in the last couple of years. Now, another thing that I'll just quickly mention is with this concern around tariffs and trade, the dollar, which bounces around a little bit over time, basically in the more recent period has declined a little bit after strengthening. And so again, that's something that people look at as it relates to sort of the strength of the dollar as we're purchasing goods and services from around the world. And interestingly, we'll make note that when it relates to other currencies in other countries, when we're invested away from the dollar, this move actually benefits those other investments, if that makes sense. And so anyway, as it relates to the way the markets operate, I talked about our capital market assumptions that are kind of forward-looking. When we look back in time, you can see here's some data that I think is super interesting. And so you can say, this is just sort of over time, when do we see a 5% decline or 10% decline, 15 or 20% decline? And so the 5% moves actually happen a couple times a year on average. The 10% move, which is called a correction, is about every year and a half on average. A 15% move about every 3 years, and then that 20% move, which is sort of described as a bear market, is about once every 6 years. And so, again, what I think it's important to take a pause and realize is that the level of decline, if you will, that we've experienced while feeling painful, brings us back to middle of last year, and there are numbers that are sort of within the norm of what we would expect in terms of the behavior and the volatility of the stock market. Now, there has been around uncertainty and worries about tariffs and a slowdown in the economy, a good amount of erosion of animal spirits. Sometimes the markets feel like there's a little bit of fear built in. People are worried. And what happens is volatility goes up when we see that fear. So this happens to be the VIX index. It's sort of a careful calculation based on options on what the market's implying in terms of forward-looking volatility on the market. So it's bumped up a little bit. So then we've talked about that. We expect volatility to be elevated here for a little while. But this chart, I'm going to show you a couple of charts that remind us about this idea of how the market behaves. So here's a chart where the green bars represent calendar year returns going back all the way to 2000. And the dots represent during the year the largest peak to trough decline. So every year there's a peak to trough decline. And yet, on average, of course, when you look across the green bars, most of the bars, not all, but most of them, many of them, are positive. So the idea with this is to say, look, you can have these big drawdowns in a market, and it can feel really scary and really nerve-wracking, but more often than not, the market ends up recovering and oftentimes from that posting a positive return for the full calendar year. So it's one way of sort of reminding ourselves not to get too worried about these bouts of downside volatility. And then this chart, I think, is an important one in the sense that we looked in this case at periods where the S&P was down at least 15%. And then how much it recovered from there and how long it took to recover. And that, the punchline is this sort of reminds us of the reason as a long-term investor to remain invested, but also sometimes the period of recovery is relatively quick. And so, sometimes you'll hear people say, well, I'm going to jump out of the market now that it's down. I'm really nervous. But, really to miss the return, to miss the recovery, and not know when to get back in is really, really challenging. And so we guide people, of course, to rebalance and be diversified, but ultimately remain invested if you're a long-term investor. Now, just to close out, looking forward, I'll just remind folks that we do stay anchored in these longer-term themes around technology and securing strategic resources and studying demographics and how consumption gets done. And these days, productive competition, which is very much about, not exclusively, but extensively about U.S.-China competition, for example. And so all of this influences the way we're thinking about the future, the way we're thinking about markets, and the way we're thinking about investments. I'll close by just saying, hey, reminder to check out stifelinsights.com website with this kind of work and a bunch of other things as well. So again, thank you so much for checking out this session of Investment Strategy Brief, and we'll see you in May. Thanks so much.